Hello and welcome to the Global View on this Thursday. I'm Andrew Gagan. Good to have you with us here at AusBiz. Let's see what happened on global markets overnight. They weakened a little further as US job openings fell to their lowest level in 3.5 years. On Wall Street, the S&P 500 and Nasdaq finished lower in choppy trade, dragged lower by energy and tech stocks, while the Dow was boosted by the utilities and consumer staples. Shares in Nvidia, which lost $279 billion in market value in the previous session, fell further, with investors questioning the chip designer's AI-driven gains. Its share price has now come off around 13% since it reported results a week ago. And the company also denied reports that it had received a subpoena from the US Department of Justice. Other mega-cap growth stocks fell, although Tesla shares did rebound. Advanced Micro Devices rose after it named a former Nvidia executive as its senior vice president of global AI markets. And shares in cybersecurity company Zscaler plummeted after the company forecast fiscal 25 revenue and profit below estimates. And Dollar Tree shares slumped after the discount store operator trimmed its annual sales and profit forecasts. Well, in a sign of continued easing of labour market tightness, US job openings dropped to a 3.5-year low in July, down to 7.67 million. The data prompted traders to raise their bets to a 50-50 chance that the Fed will deliver a 0.5 percentage point reduction at its next policy meeting this month. Further boosting bets were comments from Atlanta Fed President Raphael Bostic, who said we must not maintain a restrictive policy stance for too long. The data and our grassroots feedback describe an economy and labour market losing momentum. Well, US Treasury yields fell following the jobs data, with the yield curve between the 2 and the 10-year note briefly turning positive. The yield on the 10-year note fell to 3.778%. The 2-year initially fell 10 basis points to 3.772%, the lowest since May last year. And the US dollar has slipped against most major currencies, with the Aussie trading at 67.2 US cents. Let's get across what we're seeing stateside. Ira Epstein joining us from Lynn and Associates. Ari, good to catch up with you. So, of course, we're also looking ahead to that key non-farm payrolls figure at the end of the week. What are you seeing in the jobs market? How are you seeing the market interpret those numbers?
Well, weak. The market is finally seeing the impact of the high interest rates. The Fed is a little late to the party. That's why they may go 50 basis points. They don't want to spook the market, so they'll wait right now. But seeing a 3.5-year low in the JOLTS number, that should have gotten everybody's attention, and I know that it did. So now the question is on the jobs. Now, if those start coming in weakness, then the Fed goes. Here's the beauty, though, Andrew. We're going to get a rate cut, and then we're going to get cuts behind it. So the question, you're almost playing with yourself if you just go, oh, it's 50, it's 25. Does it really matter? All right. It doesn't. The Fed can go 25 now, 50 later if they want. One way or the other, there's at least 75 basis points, as I see it, baked into the market between now and the end of the year. And then after this, we'll spend a week after Friday, 1 week debating what's the Fed going to do, which is folly. And the bigger story is really what's going on in the stock market. And please, traders, understand AI is here to stay. The market took everything by storm. Prices went up dramatically, $140 a share temporarily in NVIDIA is too high. 100's probably a fair game for it. It's a nice pullback in the market. And you have to decide, do you believe in it or not? Now, if you believe in it, use these deep breaks over time to slowly accumulate shares in companies like NVIDIA. If you don't believe in it, then you run for the hills and you go, none of this makes sense. Everybody's spending money. They're not going to see returns for a long time. That's true. But go back to Apple phone. When it first came out, the streets were lined up and it was an expensive phone, way more than the other phones that were flip phones and so on. Can you live without your phone? Leave it at home for 2 days and tell me how you do. Well, I predict in 3 years, because of AI, it'll be the same thing. You'll be using it all the time. You already are. When you text message and on your phone, words come in and it corrects the spelling and does all that. That's just on the phone. I have it on my computer and I use GP. Excuse me. It's not good yet, but I see what it's going to do. Everything at the beginning is at the beginning. It's all a big beta test.
But of course, this is the question investors are asking, and I guess perhaps we've seen this play out with Nvidia, given how far it's come off, is that, all right, given the huge upfront costs in AI, the capex there, that investors are saying, hang on, we're not going to get those immediate returns. But you're saying, well, yes, but they're going to come.
Yeah, that is exactly. And I'll give you another one that's great for NVIDIA. Just like your computer at home, mine at home, mine in my office, how long does a computer stay up to date? Is it 5 years? And if you think it's longer than that, then within another year or two, you'll find that the software makers won't support the version you have. It's either not got enough memory, it's not fast enough, whatever it's doing. So you're into the commodity game. And in the commodity game, for the moment, NVIDIA is the leader. Others will come on board. They'll chip away at it. NVIDIA will have a great place for its highest end, but the others will pick up the scraps at the bottom. There's nothing wrong with that. Bottom feeding has made people a lot of money. Intel's in trouble, and this is going to hurt the Biden program because they're supposed to get lots of money from the federal government, and they're going to need it. They're a company that didn't stay up to the time. But if you're to ask me, no, I think that AI is here to stay. There is no immediate return. You're investing in the future. If you can't do that, don't play this game and do what Apple's doing. Rely instead and use other products that are out there to enhance it. And behind the scenes, do your own thing that you can afford to do. Apple's being very brilliant with this.
So, Ira, what are you seeing on the share market at the moment? Obviously, volatility is back. How much of this is seasonality? Traditionally, of course, we see September and October are fairly weak.
Probably if you talk to a guy like me that is a seasonal trader, I buy seasonal services. I'm going to rate 70, 80% of this is seasonal right now. For whatever reason, September is traditionally the weakest year of the month. Now, that can last September, a good part of October. You start bottoming in November, and then I'll be here with you, Andrew, and we're going to talk about the Santa Claus rally. I'll be there wearing my hat saying you're going up, and inevitably you get a Santa Claus rally. It would all fall apart, my thinking, if all of a sudden a deep recession were to happen. But I don't see how a 4.2, 4.3, 4.4% unemployment number in the United States is recessionary. That is a low number. It means people have money. If you studied the JOLTS, people are no longer changing jobs. If you study JOLTS, you see that wage gains are not there. So they're minor. They're probably not even keeping up with inflation at this point in time. Who's going to go ask, can I get more money? If you're let go, where are you getting a job? That's what the market is saying. So no, people are staying put. And I think this is a healthy economy in the United States in severe need of PEs getting back down to where they belong, in severe need of getting rid of the tightness that is put on, and in severe need of some stimulus coming back into the market. I think it's going to get all of that.
So, have you taken anything off the table, or are you remaining fully invested at the moment?
Oh, no, I'm not nowhere near full. As I told you, did I not tell you over and over? You and I have been here, said you had to take a portion of your money and put it in 5%. You were getting that all day. People now calling me, where can I get 5%? It was there for a long time, yields. Now you cut back. Cash, there's nothing wrong with holding some cash for a while. So you're going to get 3% in your money market fund. Let this break develop. This is not the place to be a hero. This is the place in the big stocks that you haven't had a chance to buy to nibble in. You buy 10%, and if another break, you buy another 10, you build a position. Don't go over maybe 30, 40% of what you want to own. Let the market come alive out of this break, and then be prepared for regular moves back. I think you can go lower in these markets in the near term. You don't want to be early. I think September's a bad month to be early.
All right, just to round off, and perhaps where we began in terms of what the Fed is likely to do, is say it's not so important as to how they get there, because they're going to get there, be it 75 or maybe 100 basis points by the end of the year. However, is the first cut not important in that if they were to go 50, that would indicate to the market, hang on, we actually seeing some real weakness in the economy, and that could actually worry investors?
They can, if they go the 50, they'll say it's because the labor's weak. They already set you up for it. The Fed said they're not studying inflation. They think they've got that to the point where it's ingrained to the downside. And we're seeing that. Look at energy prices, right? I mean, I don't care if the Fed X energy does things. We all know that inflation, we pay for that energy, and it's in a collapsing state. And unless OPEC does something to say they are not going to flood the market with more oil, they've got a problem. So you've got that. You have other markets coming down. Labor costs aren't going up. What's really inflationary today? Even shelter costs are starting to weaken because as rates fall, the money to hold the properties isn't as much, and you need not charge as much in order to keep your renters or whoever you're getting there. So these are things you watch. So my answer to you is no. I think you've got to be careful here. I don't think, and I'm going to repeat, September's not the time to be a hero. The street is laden with them in early October. Do you remember the October break in the 80s? I mean, it can be treacherous. It's November that I feel better. So when you ask me what to do, be a trader right now, not an investor, unless you're picking up stocks at deep discounts that you've been wanting to own.
Ira, thanks for joining us from Linen Associates.
Thanks, Red.
Quick check of the local market before we get going. We are expecting a flat opening there. As you can see, SPI futures up just 2 points. Stay with us because the open is a couple of minutes away.